Throughout my years of investing, there's been some times where I've made some pretty mediocre investments. Now, the good news is that the overwhelming majority of these events took place when I was more naive to investing. In my early to mid-20s, back when I exclusively pursued growth stocks, there'd be situations where I'd lose money on an investment that I only bought because some hotshot in a magazine touted it as being the next Microsoft or Chevron. I didn't bother looking at financial statements or even paying attention to the stock market or the economy's performance. These experiences that I went through are what ultimately led me to become a dividend and an income investor. I got tired of trying to put my money in a high-risk growth company with an extremely volatile share price and hoping things would just work out. I found it a lot more peaceful to invest in holdings that don't offer much in terms of share price performance, but offer a very steady and often very high dividend yield. But this doesn't mean that once I started pursuing higher dividend investments that I didn't make mistakes. Along my investing journey, I've still made mediocre investments here and there, although the majority of them haven't been as bad as some were in my younger days. But an investment I made 2.5 years ago was unlike any I had ever made before. A poor investment choice along with a crashing stock market resulted in the worst investment I ever made in my life. So in today's video, for the sake of transparency, I wanted to share with you all what my worst and most embarrassing dividend investment ever was. I also want to discuss some really important lessons that I learned from this mistake that I hope nobody else will ever repeat. My hope is that this information will help people avoid doing what I did, which ultimately cost me thousands of dollars. It all took place in early 2020, right before the COVID pandemic. At the time, I had thousands of dollars sitting on the sidelines in a savings account waiting to be invested in some high-yielding stocks and ETFs. After doing a great deal of research, I'd come across an ETF that looked really appealing to me for several reasons. It was the Global X Super Dividend REIT ETF, ticker symbol SRET. It's a REIT ETF that basically holds some equity REITs like WP Carey and gaming and leisure properties, but for the most part it holds a lot of mortgage REITs like Dynex Capital, AG&C, and PennyMac Mortgage Investment Trust. Upon first looking at this ETF, it had quite a number of things that I really found attractive about it. For one thing, at the time it was offering a dividend yield of roughly 8% and it paid dividends on a monthly basis. When looking at its share price between March of 2015 and February of 2020, it had basically flatlined in terms of performance, which I had absolutely no issue with. If a stock or an ETF can provide me with a consistent 8 or even 10% dividend yield but offer nothing in terms of share price growth, I'm perfectly okay with that. I'm the kind of investor that loves high cash flow from a sturdy investment, especially one that pays monthly dividends. So the fact that the share price wasn't moving up or down wasn't concerning to me. Its dividend distributions had been for the most part very consistent. Originally paying 10 cents per share, it had a history of reducing and then increasing their dividends. You can see that it'd go from paying 10 cents a month down to 9 and then 8 and then back up to 10 and so forth. It also had a history of paying some large special dividends every December. And finally, I figured that since it's an ETF, that means it would be safer because it holds a diversified collection of different companies. If one of them fails or underperforms, I took comfort knowing that there would be roughly 28 other holdings in this fund that would help sustain it during a difficult market. In February of 2020, the market began to fall in what we know today was the start of the pandemic plunge. In just 2 weeks, the S&P 500 had fallen by more than 12%. During that same period, the Global X Super Dividend REIT ETF had also fallen roughly 12% during that time. Between February 28th and March 6th, the share price had basically flatlined, which led me to believe that the worst of the plunge was over. Believing that I could time the market, I decided to make my move and I invested $15,000 into SRET. I bought 1,066 shares of it, and I calculated that it would pay me a little over $107 a month in dividends. At the time, I thought this was a great buying opportunity considering the market had just fallen by more than 12%. I believed that the market wouldn't dramatically fall any more than it already had. Since it tanked for 2 weeks and then remained stable and slightly up for 1 week, I believed that the worst of the plunge was over. But of course, that's not how things actually played out. Just days after I made my purchase, the market would continue to fall even more dramatically than it had before. For a little more than a month, the market kept falling until April 3rd when SRET had reached its all-time low. Before I knew it, my $15,000 investment had lost roughly 62.94% of its value. What made things worse was my dividends were dramatically cut too. Originally paying 10 cents per share in March of 2020, the dividends were reduced to 7 cents just a month later. 2 months later, the dividend was cut again to just 6 cents per share. 6 months later, the dividend had kept falling to now roughly 5 cents per share. So not only had the share price collapsed of this ETF, but my dividends were reduced by 50% since my initial investment. But things could have been much worse. Had I panicked and sold in April of 2020, I really would have lost a ton of money. But I decided to hold on to it, and all the while I kept reinvesting my dividends. I held this REIT ETF for an additional year, and between April of 2020 and June of 2021, the share price had grown by over 90%. But after taking a deep look into the financials of the companies this fund held, it was clear to me that this ETF wasn't going to climb back up to the share price I bought it at, or even anywhere close to that for a very long time, if ever. The problem was these mortgage REITs took substantial losses from their loans and their book values plummeted. In the end, I sold all of my shares of SRET in mid-2021 after losing nearly $3,000. Needless to say, it was a pretty painful and embarrassing experience for me and my wallet at the time, considering I had invested so much right before it immediately tanked. But as the old saying goes, we should never waste a mistake, but instead learn from them. So now I'd like to go over a few lessons that I learned from this experience, so hopefully others won't follow the same path that I did several years ago. First off, for those of you who happen to know a lot about technical analysis, or if anyone watching just happens to be a day trader, you probably know that I fell victim to what's known as a dead cat bounce. This is a phenomenon that occurs when a stock falls by a good amount and then investors will rush in and try to buy shares in order to take advantage of the discount, but then it'll dive even further. According to Investopedia, they describe it as a short-lived recovery of asset prices from a prolonged decline or a bear market that's followed by a continuation of the downtrend. Obviously, what I had experienced was a textbook example of this. You can see that I invested right on this little cliff here right before the share price dropped. Now, I'm not a technical analysis kind of person, so I didn't anticipate that the share price would keep falling. Whenever you're researching a stock, there's two types of analysis that you can perform on an investment. The most common type is called fundamental analysis, which involves looking at financial statements, analyzing economic conditions and industry trends, and so forth to determine if a stock is a buy or a sell. Technical analysis, on the other hand, involves looking at statistical trends and stock price graphs to try to predict what a stock's share price will be in the future. According to people who are really into technical analysis, had I known more about using technical analysis, it's possible that I could have avoided this situation altogether. But ultimately, my biggest flaw was trying to time the market. All the greatest stock market investors in the world, from Warren Buffett to Charlie Munger and Peter Lynch, are very critical about the idea that you shouldn't invest until you think you've seen the market bottom. Buffett himself said he has no idea what the stock market is going to do tomorrow, and we don't know for certain either. Instead, what investors should do is consistently invest a fixed dollar amount on a regular basis, regardless of how the stock market is performing. This is what's known as dollar cost averaging, and it's proven time and time again to be the best investing strategy out there. I do still make larger than average investments if I think there's a good buying opportunity, but not nearly as big as what I spent on SRET in 2020. But making steady investments into your holdings every single week or month, regardless if the market is up or down, is the better option when comparing to try to time the market. Most people tend to think that they're smarter than average and can predict when a market will bottom, but many studies have proven that it can't be done consistently. A few people have gotten extremely lucky, but nobody has ever been able to predict the bottom over and over and over again. Another lesson I grasped from this experience was just how incredibly risky mortgage REITs are compared to other high-yield investments. Looking back during the COVID pandemic, if you'd compared M-REITs to virtually every other kind of high-yield investment, like equity REITs, business development companies, master limited partnerships, closed-end funds, and covered call ETFs, mortgage REITs suffered the absolute worst. What makes things worse is that M-REITs can't easily recover once they've suffered sizable losses, so I suspect for a number of the stocks inside this ETF will either never recover to their pre-pandemic price, or it could take years and years to do so. Finally, one more lesson this disaster reinforced was the importance of diversification in your investment portfolio. While SRET currently holds about 29 different holdings inside of it, if you compared with the Vanguard Real Estate ETF, ticker symbol VNQ, this one actually holds 170 different stocks in it. I know VNQ does offer a much lower dividend yield than 8%, but 29 different holdings really isn't a lot for an ETF. And considering M-REITs are so risky, that's not nearly enough diversification just in case the market tanks, which is exactly what happened. All investors need to diversify their portfolio across different holdings, sectors, and investment types. A dividend investor should look to hold a wide range of different paying dividend stocks like equity and mortgage REITs, business development companies, closed-end funds, and so on. Owning ETFs that are actually much more diversified can help with this, like SCHD, in terms of providing diversification. For people who only want to hold individual stocks, according to most experts, they suggest holding at least 20 different holdings. You can hold more, but once you get past 60 holdings, they say there really isn't much added benefit to it. Plus, the more that you hold means that you have to spend more time regularly analyzing each company. So I always like to recommend between 20 and 30 different holdings. So to summarize, the most important lessons from this experience I had would have to be the following. Whatever you do, do not try to time the market, because even if you can on one occasion, you won't be able to successfully do it over and over again. Second, dollar cost averaging is the best investing strategy out there that nearly all incredibly successful investors do themselves. Third, be sure you understand the risks involved in what you happen to be investing in. And finally, always diversify your portfolio and don't hold too much in one specific sector. If you follow these rules, your odds of failing as hard as I did in early 2020 will be close to impossible. And that's going to conclude today's video. Thank you all so much for watching. I really do appreciate it. If you found this video informative, please consider giving it a thumbs up below, and also subscribe to the channel if you want to see more high yield dividend investing strategy videos. It would just let me know that there's enough people out there who want this kind of content, and I'll continue to provide you all with that content. Alright, thanks again guys so much for watching, and until next time, take care.